Good afternoon, everybody, and thank you for joining us on today's webinar by CryptoUK and brought to you in association with Chainalysis. Today's session is titled Regulation, Same Risk, Same Regulatory Outcome, looking at crypto regulation here in the UK. Just for all of the people on the call, to advise you this session is being recorded and we will be having some time at the end of the session for questions and answers. If you can drop any questions you have into the chat during the session, I will put those to the moderator and the panelists throughout the session and at the very end when we have the time allocated. I'd like to hand over to Jordan Wain from Chainalysis, who's going to be your moderator for this event, and will take you through the intros and the opening opportunities for our members to participate. Thank you.
Perfect. Thank you very much, Sue. It's a genuine pleasure to be here as part of such an excellent lineup, and thank you all for taking the time out of your day to dial in or to watch the recording of the session, whichever you are dialing in with. Now, with everything that's happening, it would be easy to get distracted, but we're going to endeavour to keep our focus on what's happening in the UK and to specifically hone in on the consultation and call for evidence on the future financial services regime for crypto that came out at the start of February. Now, as Sue mentioned, we do have an excellent lineup, and as much as we like to hear ourselves talk, we'd also love to hear from you. So please do post your questions in the chat and we'll get to these at the end of the session. My name is Jordan Wain and I work for Chainalysis as part of the international public policy team, having joined from the FCA. Our main job is to work with the firm to think about the needs of our public and private sector clients and to think specifically about the regulatory and policy developments coming down the pipe in the UK and across other jurisdictions that we operate in. And really it's up to us to understand what the impact is for us as a company, our products, our clients, and the industry more broadly, and how we might need to respond. Chainalysis are a blockchain analytics provider, one of many in the market, and very simply, we work with government and private firms to give them the software and the data to help them to understand what's happening on the blockchain. Our fundamental purpose is to highlight any potential exposure to illicit activity or financial crime and make sure that our clients are, one, benefiting from the fundamental transparency and visibility of the blockchain, and two, that ultimately they have what they need to protect themselves, their users, or their citizens from potential criminal activity and subsequent harm. That's my introduction. I am just going to give a very brief overview, some context to what we're discussing today, to set the scene around the consultation before I jump into the first question for our panelists. So the consultation that we saw from HM Treasury goes some way to satisfying our desire to see something comprehensive from the government about their plans for regulating the sector. What it contains is a series of proposals for a financial services-like framework for crypto that takes us beyond the AML CFT obligations that already apply to the sector under the MLRs as overseen by the FCA. The consultation is wide-ranging. It outlines a phased approach to regulating the sector with a series of proposals that, among other things, set a very broad geographical scope, capturing UK and non-UK firms, establishes a standalone market abuse regime, and outlines a series of detailed requirements and outcomes for some of the principal crypto activities that it feels deserve regulation. Now, if we stick at the 1,000-foot level to think a little bit about the what of the consultation's proposals, they're all connected by this golden thread of same risk, same regulatory outcome, which is one of the key design principles underpinning the consultation. And the impact of this is to essentially treat crypto activities the same as traditional financial services activities. The thinking is that since they are more or less the same activities, they create the same risks, and therefore regulation should be broadly similar. And in theory, it should work to achieve the same outcomes. And this is fundamentally what drives the core proposal of the consultation, which in one admittedly very long sentence is to fit digital assets and activities inside the existing UK financial services framework and specified investments and activities under the as specified investments and activities under the RAO of FSMA. And in doing so, to level the playing field between traditional and digital assets. So with that, context is set, the baseline is there. I'll move on to the first of our questions today. So panelists, with this first question, please do take a moment to introduce yourselves, where you're from, and then please share your thoughts on the same risk, same regulatory outcome design approach and how it impacts the UK's digital asset framework. So Dina, if I can ask you to kindly go first and share some of your thoughts.
Yeah, sure. Hi. So I'm Dina White. I'm General Counsel for Zodia Markets. For those who don't know, Zodia Markets is the only bank-backed FCA-registered digital assets exchange and brokerage in the UK. And we're an institutional-only firm. We also have a multi-custodian model where we don't hold any client digital assets ourselves. Our clients hold them with custodians themselves. So my response to that, to the design principle of same risk, same regulatory outcome, is that is absolutely the right one in principle. In practice, there may be a few challenges, which I'm sure we'll come to. If we compare it, for example, with MiCA in the EU, they've got a whole separate proposed regulatory regime which views digital assets as a separate type of asset. Which is, which also works in a different way. But I think the UK's one approach is preferable, not least because it allows for a level of flexibility. So it's integrating the way we see digital assets into the traditional financial system, but allowing flexibility to change as the technology develops. And obviously, because it is such a fast-moving area of technology, I think that will fit this type of assets better than another approach. There obviously will be challenges, and as I said, I'm sure we'll talk about them. I mean, if I just talk about three, for example, if we're talking about disclosures and the obligations on trading venues, for example, where there isn't an obvious issuer, like with Bitcoin, the disclosure obligations will be on the trading venues. And so how will you allocate risk between those trading venues when you're each producing perhaps different disclosure documents? If there are prudential requirements, how's that going to be allocated between the venues, for example? Another one is, again, on issuance and trading, there doesn't seem to be a real distinction between wholesale and retail. And obviously where you're dealing with consumers, there is an additional layer of safety that you'll need to impose and liability that you'll need to take on when you're dealing with consumers. Whereas when you're dealing with institutional clients, there could potentially be more of a distinction there, and those institutional clients taking on some of that responsibility themselves. And the third one is that while securities and security tokens are distinguished, it does look somewhat like everything is being treated as a security, and the way that this whole regime is being approached. So I think there is just another distinction that needs to be worked out through the consultation. But I'm sure we'll come on to the other issues later. Not sure who's talking next.
Yeah, thank you so much for that. George, if you wouldn't mind going next.
Oh, of course. Thanks, Jordan. So yeah, my name's George Morris. I'm a partner at Simmons & Simmons. So for those of you who don't know us, we're an international law firm, and we've been working in the crypto sector for about 7 or 8 years now. So my client base are a large proportion of CryptoUK members, plus a lot of global platforms. But yeah, on this question, it's an interesting one, because I think if you look at it at the top level, it makes perfect sense what the FCA, what the HMT are proposing. So they are considering that that crypto represents the same level of risk as securities trading, and as a result, they are seeking to apply, as Dina described, sort of the same, effectively treating them as securities, and having, in order to be able to run a crypto asset service provider business, you're going to have to get authorized effectively as an investment firm in the same way that you would if you were arranging or executing transactions in securities in the UK. And so at first glance, it kind of makes sense. And I do totally agree that same risk, same regulation does make sense. But then actually, I think that there's a nuance here that I think HMT maybe haven't quite gathered or haven't quite represented, which is that, and the nuance is maybe underestimating how big this point is, which is the crypto industry operates very differently from the securities industry. Now, I know that ultimately that's kind of what same risk, same regulation is trying to deal with, the fact that, you don't care how the market operates. It's let's try and deal with the risks that it presents. But really, the fact that it operates in a different way does present different risks to securities markets. And it's those types of risks that I think have maybe partially been overlooked when it comes to the consultation. So to give you a couple of examples, one of the things is obviously, as we all know on this call, that crypto can be held by an individual on a non-custodial basis, which is a very powerful part of the crypto industry, and one of the reasons why actually, crypto is so revolutionary, because it enables you to hold these things that look a bit like securities but aren't securities, just to be clear. But you can hold them yourself. Whereas if you're investing in dematerialized shares, for example, you have to hold them through your broker as an individual, and so it's a very powerful thing. But of course, non-custodial solutions represent benefits and they represent risks as well. And that just hasn't been properly dealt with, I think, in the consultation. The idea that actually, for example, we could have had this concept of a custodial versus a non-custodial exchange authorization, which would have probably looked quite different when it comes to the types of activities and the types of compliance requirements that would be imposed on those entities. And we are increasingly seeing non-custodial exchanges, which represent different risks to custodial exchanges and have their benefits and disadvantages, of course, as well. That's one example. I think the other thing, just to build on something that Dina said, was they're treating everything as securities or equivalent to securities. And I wonder whether that makes sense when you look at the breadth of the types of assets that they are covering under this consultation. So obviously, crypto assets more broadly, your classic exchange tokens, it makes sense that they would be at the center of this. And then we have around the edge of that core definition, we have different flavors of crypto assets like stablecoins, asset-backed tokens, NFTs, algo tokens, all these things. And generally quite a blanket approach has been taken with respect to all of those, apart from e-money tokens, which are being treated under a separate consultation process as effectively e-money instruments. Putting those aside for a second, when you look at, say, NFTs, they represent a very different risk from other types of crypto assets. And I think we need to think about where the nuance should be in relation to that. I mean, just to sort of bring everything I've just said together, it's kind of, it makes sense that same risk, same regulation is right, but you can't ignore the way the markets actually operate and how, have we identified the risks that actually need dealt with, or are we just assuming that securities markets and the risks within those are equally analogous to what comes up in the crypto sector? And I'm not sure that's a fair thing to do in practice.
Yeah.
And just to dig a little bit deeper there, George, sorry. So this is obviously a consultation. It's a series of proposals. And did you envision this coming out in the wash as part of the feedback, as part of the, when do you see this? Do you see this as something that HMT recognizes, something they need to provide more nuance, more clarity, more guidance? Do you think this is just because we're at such an early stage, or do you think there is something that they're missing?
I think, and I'll maybe throw that one to Katie shortly, because I know she's very heavily involved in consultation responses in her day job. But certainly from my perspective, the consultation, I think the industry needs to be quite well aligned in terms of how we're going back to HMT to make sure that we are coming up with a combined view as to really where we need to get to on this stuff. One of the things that I'm really keen to push is that clearly, as an industry, we cannot pretend that this isn't going to happen, and we need to embrace the fact that this is a part of the new world of operating a crypto business. Clearly, regulation is now front and center crypto, and will continue to be for the rest of its days, most probably. The question is whether or not we can shape what we've got currently on paper in the UK to make it work best for the industry, work best for the regulator as well, a nice balanced approach. I was on I did a webinar yesterday with the FCA talking about their discussion paper on the updates to the fund management industry in the UK. And part of that, I asked the question to them about how they balance consumer protection versus innovation. And they were very clear on the webinar yesterday that they see their new requirement to maintain competitiveness of the industry as being secondary to consumer protection and maintaining market integrity. And we need to be aware of that they have a secondary requirement to ensure competitiveness, but their primary requirements are consumer protection and market integrity. What we need to go back with on the responses to the consultation is how we can make those two, keep those two requirements front and center, but without necessarily, creating a solution that puts crypto square peg into securities very round hole, if that makes sense.
Perfect. That totally makes sense. Katie, would you mind
Yeah,
taking...
sure. So hello, Katie Harries. I lead on European policy for Coinbase. You probably know who Coinbase is, but we're the largest crypto exchange in the world. We're publicly listed and we have millions of customers across 100 different countries. So I'd start by saying that we also agree with the design principles, same risk, same regulatory outcome. And I think this is a better iteration than what we've heard elsewhere. And I noticed that other panelists have talked about same risk, same regulation. I think same regulatory outcome is slightly different. And I hope there's, as part of that, some kind of acknowledgement that you do need to adapt to a certain extent existing financial services rules as they apply to crypto. And I think the devil will be in the detail on that. And I think there is some recognition within the Treasury that technologies underlying crypto differ in meaningful ways from those in traditional financial activities. And as a result, the risks and the benefits can also differ. And just to flesh that out a bit more, where blockchain technology offers the creation of open, immutable systems for recording ownership and transferring value. It enables real-time settlement, reduces credit risk, lowers cost to consumers. And because of this, it greatly reduces the need for intermediaries, which in TradFi, obviously, regulation is very much built around. And I think that this technological leap forward provides participants in the system the opportunity to reassess market structures from first principles. And I think that's why the same regulation may not be appropriate, but the same regulatory outcomes is appropriate. And I think it will be important as the kind of rules are fleshed out that the rules are adapted to reflect new and different risks, but still very much focusing on achieving those same regulatory outcomes. And I very much hope that as the more detailed rules develop, that will be reflected. I would say just more generally on the consultation, I think it's an extremely positive development in terms of providing much needed regulatory certainty to the market. I think the licensing regime will send a very clear signal to the market of which firms meet minimum standards and help really create a legitimate and trusted industry of crypto asset firms. I think it's also interesting that there's that clear desire to bring crypto activities onshore into the UK. Interesting that the UK is looking to move towards the concept of reverse solicitation versus the OP regime, which is used in TradFi. And I'd love to hear your observations on that, George. I think that's a very interesting move. But I think as part of that, it's just very positive that there's a focus on designing a framework in a way that kind of prevents misuse and arbitrage by offshore companies. And at the same time, rightly recognizes that an equivalence regime could encourage more consistent regulation across international markets. So I think it's a major step forward in terms of creating the right incentives for firms to operate onshore and from jurisdictions with equivalent regulatory standards. And then in terms of areas that we would want to see the UK get right, three things just to mention very briefly. Asset listing and disclosures. So to the point made earlier, who is liable for those disclosures? Is it the issuer? Is it the platform? What can the platform reasonably be liable for in that instance? Then how to manage conflicts of interests. We see conflicts being managed in TradFi every day. How should they be managed in crypto asset markets? And then, of course, DeFi regulation, the call for evidence there. Maybe that's a topic I can maybe return to later.
Great, thank you so much. Sticking with this sort of same risk, same approach, I mean, is it anything particularly novel? I mean, we've been, as far as I'm concerned, it's something that we've been hearing from other jurisdictions, we've been hearing from international regulators. Why is it getting such momentum across the globe when it comes to thinking about applying rules to the sector? Is there anything behind this? Is it just the way that we form regulation now? I mean, from the CFTC through to FSB, BIS, BCBS, this sort of keeps coming up. Does anyone have any thoughts on why that might be? Or I mean, we even see it in the UK with their ongoing future regulatory framework work. It's central to that.
If I could just come in on that. So I think partially it's a response by the regulators to very, very quick change in markets. So I think one of the things that if you ask the FCA about sort of how do they feel like things could have gone better in terms of crypto regulation in the past few years in the UK, I think one of the things they would have said is that they need more powers to be more agile because the speed of the market makes it very difficult to regulate. And I think as a result, one of the things that they try and do is to try and put in place, they're trying to build frameworks that enable them to have more powers that get to the same, to Katie's point, same regulatory outcome, but making sure that we, doing it in the right way And we're seeing that more and more, delegation down to regulators within the UK that's coming out as a result of the Financial Services Markets Bill, the Edinburgh reforms and things like that, is that sort of delegation in order to increase the speed at which we regulate. Obviously, that's good and bad. It's good from the regulator's perspective, but it can be bad from the industry's perspective. But ultimately, it comes back to, how we operate as an industry and making sure that we're doing all the right things, which means that you're not going to be subject to, horrific oversight designed to slow the industry down and prevent consumer harm, which ultimately is kind of where the regulators are coming from at the moment.
Yeah, no, I totally agree. I think if I were to speak from, so I guess moderators aren't usually allowed to have an opinion, but I guess, I totally agree with what everyone said. I think that the intent is correct here behind this principle, but indeed, more nuance, more clarity is needed to be catered for, to understand. I mean, there are similar risks, similar activities. There are different business models entirely involved here compared to traditional finance. I think one area that could be particularly limiting, if we were to apply the same approach, would be when it comes to data and reporting responsibilities that are going to form a part of this framework, and the obligations that are eventually set for firms in terms of what they need to report. I think transparency and data reporting are some of the key things that regulators have at their disposal, alongside prudential safeguards, risk controls, and all of these make up the usual gamut of things that regulators do. But it would be a real shame if they weren't to use the opportunity to think differently about reporting and think about how the visibility and transparency of what we have here, how that could link into supervision and enforcement processes. I think it is encouraging. I will say that the FCA there's been a big push at the FCA to be a data first regulator. They've invested in data capabilities, personnel. They're putting a lot of time behind, sort of pivoting that sort of intent to being data first and making sure they have the tools available to be smarter, particularly when it comes to crypto assets and AML CFT regulation. So continuing that sort of embracing the potential is something that I hope to see, particularly as part of these regs and what obligations are set.
One thing, Jordan, one thing I was just going to bring in here, maybe it'd be interesting to hear Dina and Katie's views on this too, which is one of the key risks in crypto in this industry is around cross-border servicing and the ability for entities to avoid regulation by operating outside of its jurisdictions. In many cases, very perfectly legitimately, but as we move towards a model that's more heavily regulated in the UK, and this applies equally to Europe, we have more of a question about the big elephant in the room, which is how, for the entities that choose to engage with these models and actually, go through the difficult, complex and expensive process of getting authorized to operate in the UK or the EU, how is their investment being protected by the regulators by doing cross-border enforcement against entities that are breaking the law? And at the moment, it's a big elephant in the room because at the moment, all we see in terms of cross-border enforcement is from the US, because the US regulators have the money and they have the power to do that. And I think there's a key question here for the industry in the UK and also in the EU about how we deal with that. It's a different risk from securities because there's not the same level of kind of cross-border securities activity than we see in crypto. But I'd be interested to hear Dina and Katie's views in terms of kind of cross-border enforcement and how we deal with that as an industry.
Yeah, I mean, I personally was thinking less about enforcement, which you're right is a big issue, and more about if the territorial scope is being expanded to companies that are offering services to the UK, will they really want to go through this? I know there will be some sort of equivalence regime, but we don't know what that looks like yet. And if they do need to be authorized here, then will potential counterparties want to go through that process? It's tough enough when you're based in the UK, but if you're based overseas and you've got plenty of other markets to go to, will that prevent certain players in the market? For example, a lot of intermediaries, liquidity providers and so on may not be based in the UK. My concern is whether that will reduce liquidity to the market, for example. I mean, that's just one minor aspect. So I think there are other aspects as well as enforcement that are concerning, although again, I do think it's the right approach in principle, but the detail will be need to work out. And yes, enforcement obviously is a major issue in the US, and you know, I don't think we'd ever go down that route, particularly because we don't have that many regulators who are trying to regulate the same assets in different ways. So that's at least helpful. But yes, that could be another preventative factor for overseas firms operating here.
I agree, and I think it's widely recognised across many jurisdictions that we need to incentivise firms to kind of onshore and achieve licenses. But I think it's much broader than just enforcement. So, for example, in Europe, we know that they're looking at tightening up the reverse solicitation rules for crypto asset firms. I think more generally, when firms apply for licensing, supervisors should think through what the kind of the corporate structure, making sure that there's transparency of corporate structure. What are their links to high risk jurisdictions? And I think in Europe, they're thinking through kind of a list of non-compliant CASPs. I don't know what that will mean in practice, but I think all of these measures suggest that supervisors and regulators are very alive to the fact that that they need to incentivize firms to onshore in their jurisdiction. So exactly to your point, George, that firms that do onshore and do seek licenses are rewarded for that investment.
And I guess that kind of brings me to ask the question about this sort of phased approach that we're seeing. I mean, that could have additional implications for firms looking to base themselves in the UK. I mean, if you're seeing certain regs come in as part of phase one, but you know, your business model includes a whole range of other kinds of activities that aren't yet regulated, you're sort of, you know, taking a punt on what those regulations might look like. You're taking a risk in locating perhaps before those regulations have been set as part of phase two, as part of a you know, I think a future phase, I think they call it. So without that sort of clarity up front and sort of, you know, postponing it and bringing it in stages, there is a question about how attractive is the UK actually going to be for some of these firms that have multiple activities under one roof. So I'm very conscious that I am over time. My moderating has not been on cue, and I'll move on to question two, if that's okay. And I don't want to get too far away from the consultation itself, but I think we should do it anyway and broaden the scope a little bit, because it would be naive to think that the consultation is happening all on its own in a vacuum. I mean, for as many of you may have seen at the start of this week, we saw the draft SI for the financial promotions regime laid before Parliament, which sets the baseline for firms marketing to UK consumers, whether in the UK or abroad. And this is very clearly going to play into a lot of firms' thinking. So this is something that's sitting aside from the consultation, but is very, very much also on firms' minds and how they're going to be thinking about the UK. So with that, it would be great to hear from each of you on what regulatory, legislative, or policy moves that are keeping you busy, consultation related or otherwise. George, if you wouldn't mind going first.
Sure. Yeah, I mean, you for me, definitely the biggest one is, as you've already mentioned, Jordan, financial promotions. We've got a significant issue in the UK at the moment with financial promotions because, well, many of you will have seen yesterday that the statutory instrument was published to be laid before Parliament for approval. We're not quite sure when, but it's going to be relatively soon. And then there'll be a 4-month period after that, before which it comes into force. And that's a pretty short period of time by which to engage with this and to make amendments to all of the business models that you're running in order to be able to deal with it, from a couple of reasons. I mean, primarily because we're still expecting another FCA consultation in relation to the detailed rules on financial promotions in crypto. That's what certainly the HMT consultation from February suggested would happen. And so we still don't know exactly what the rules are going to look like when it comes to financial promotions in crypto in the UK. And as a result, there's going to be quite a short period of time by which to implement this stuff. And at first glance, that might sound okay, because generally the sort of top level requirement that, you know, you can't do financial promotions in the UK unless you've got the right approval to do so, either because you're a registered firm or because you have a third party that will approve them, or you're carrying them out under an exemption, like, you know, you're only doing them to certain types of investors that aren't subject to the rules. That's the top level piece, and we already know that. But then there's some real detail in there about how financial promotions are actually being implemented in the UK, particularly around direct offer financial promotions, which are a subset of financial promotions. This is sort of super boring legal stuff, but when you have a direct offer financial promotion, it triggers all sorts of crazy high friction requirements around how you onboard customers that engage with a direct offer financial promotion. And given the ambiguity around the definition of what a direct offer financial promotion is, that's causing a lot of problems for entities in the UK at the moment to try and work out exactly how to deal with those rules, because you either choose to engage with the direct offer financial promotions and sort of assume that everything you're going to be doing is a direct offer, and imply these very, very painful frictions to your onboarding, which include a 24-hour cooling off period before customers are allowed to start trading, which obviously is very painful. Or you try and argue the toss and say that you're not doing any direct offers. But we know that the FCA, certainly they've said to us in the past that they think that these frictions need to be implemented wholesale by the crypto industry in the UK, and that is obviously massively difficult, therefore, to navigate. And so, for me, that's the sort of, in the UK, that's the number one issue at the moment. Apart from the more obvious stuff around like just trying to get people FCA registered at the moment, it's a very, very difficult process on an ongoing basis. It's going faster than it used to be. But there's the standards, if it was possible to do this, the standards the FCA expect of an initial application are extremely high now. We see lots of applicants being knocked back without even having any questions asked of the FCA, because they now triage all applications, and once the applications have been triaged, they try and they look for initial sort of gaps, and if there are any gaps that are at all material, then they tell you to withdraw and resubmit. Which obviously means that their statistics look great in terms of how quickly they're running their application process, but it's a very poor experience from a firm perspective, primarily because you have to resubmit, pay another £10,000 to apply, and then potentially get knocked down the queue back to the start. So that's another piece that's keeping me awake at night somewhat.
Yeah, and with all that comes getting a new case officer assigned, and that sort of complexity of some of the things that they're suggesting, and so the speed of things that are coming down the pipe is sort of firms are going to have to be really alive to some of the obligations there. Even when it comes to things like what it means to be licensed and registered, and all of the additional financial crime obligations that come with that. Around breach reporting, potential for SMCR to come in. There's a lot of things that are sort of left unsaid, and sort of Damocles is sort of hanging somewhere around. Katie, I'd love to get your thoughts on that question, if I may.
Yeah, sure. So I think it's extremely positive that the government has launched its consultation. It's obviously legislating to give the UK regulators powers to make the technical rules. But I think these regulatory guardrails are very much kind of a minimum requirement for the UK government if it really wants to kind of deliver on its ambition to become a crypto hub. And I think there are many important initiatives that will make all the difference in terms of putting the UK on a strong competitive footing. And we've been very much focused on these other initiatives. So just for example, the work of the Law Commission, it's been recognised globally as leading the way on the digital property rights. Similarly, HMRC's consultation on tax treatment of DeFi and staking, which will provide important tax certainty as well. And I think these consultations are really important initiatives to put the UK at the forefront of the thinking on crypto globally. And what I would say is that the government needs to act quickly to bring these to fruition. We are also, unsurprisingly, very focused on the UK's FinProm regime. I think we share the government and regulators' desire to promote kind of a safe and healthy digital asset ecosystem, but we also think that it should be accessible to all. I think healthy markets thrive when consumers are able to take on responsible risks in kind of informed and deliberate ways. And we very much recognise that some consumers do have less experience with financial markets and digital. Important safeguards are needed. So, for example, education, disclosure are kind of paramount for consumers to make informed decisions. But I do think that the jury is still out on whether the FinProm regime gets the balance right. So, for example, the 24-hour cooling off period is something that we haven't seen in any other jurisdiction, and where the UK goes much further. So that's something that we're very focused on. Another topic I'd say related to the consultations, obviously, the UK's call for evidence on DeFi. So the UK is obviously the first country globally to consult on DeFi regulation. It'll be super important that it gets that right. I think it can really lead the way. And I think DeFi raises some really quite unique challenges for regulation and supervisors, but it also holds such incredible potential for kind of new forms of financial services. And I think it would be really important not to restrict these innovative technologies at such an early stage of development in what is effectively a nascent and very much non-systemic part of the market. So I think DeFi products are very much still developing and will likely over time require a separate regulatory framework which kind of accommodates its difference. And as the market develops, regulators will be able to see where the risks may exist and how best to mitigate them. And that new approach may take more time to design and to develop, and the government and the FCA will have to proceed really carefully to understand those risks and to preserve those kind of unique benefits of this developing ecosystem. But I think at this stage, we can applaud the Treasury because I think it's really trying to take a proportionate and innovation-friendly approach. So DeFi, another area that we're particularly focused on.
And certainly an area where sort of this same risk, same regulatory outcome would need to be considered very carefully. Dina, have you got any thoughts to add onto this question?
So those as well, I think most of everything's been said. Obviously, the financial promotions regime and the statutory instrument published 2 days ago, that's obviously we're going through that. I would add, as part of the current Treasury consultation, but the regime for stablecoins, that's obviously stage one in the current stages, and I think that will be quite important because particularly with what's going on with the US banking collapses, the recent banking collapses, it's difficult for crypto companies to use those dollar payment rails, and therefore I think stablecoins will, at least dollar-backed stablecoins, will become more important for crypto trading. So it'll be very interesting. We'll keep a close eye on the stablecoin future legislation that'll be coming out. And then just out of more general interest, the consultation on the UK CBDC, it will be, obviously that's longer term, but it will be interesting to see how that potential digital pound impacts the crypto industry, and whether we will see stablecoins, cryptos and a UK CBDC work alongside each other, or whether one will sort of positively or negatively affect the other. So that's sort of longer term, more general interest.
Yeah, and I think it's much longer term, right? It's off into the distances of 2026. I think that CBDC proposal, if I'm right. I mean, that just really shows you the breadth of things that are going on in the UK right now. You know, we haven't even talked about the Economic Crime and Corporate Transparency Bill, all of the economic crime reforms that are ongoing, the additional powers that will come for law enforcement to crack down on potential economic crime involving crypto assets. There is so much at play here, and just speaking to what George mentioned earlier, that the speed of at which these things are coming in, you know, you sort of have at one end the CBDC consultation that is not going to progress until 2026, and then you have things that are coming in right now, things that have come in this week, and you know there is just a hell of a lot to think about. So I think we are coming up to the end, so I'll make sure that we get in some time for questions 3 and some questions from the audience. So the final question is sort of a blue sky thinking sort of question. I want you to think for a moment about the future of the UK crypto asset ecosystem. Where does this consultation and everything that's happened over the past few months put the UK? George spoke earlier about this competitiveness agenda that's being brought in, the priority to ensure that the UK remains competitive vis-a-vis other jurisdictions. You know, will this framework go any way to supporting that? Will it help create a crypto hub in the UK? Do the government even still want to be a crypto hub, or have they sort of moved away from that? It'd be interesting to get anyone's thoughts on where this puts the UK in terms of being a crypto hub, I guess. Katie, would you mind going first?
Kick off. So I think the UK moving towards a regulatory framework for crypto will very much deliver the legal and regulatory certainty that the market really wants and needs, and it will give firms just like Coinbase the confidence to invest and to innovate in the UK. But I think it is really important that the UK moves quickly on this. So we've seen many jurisdictions around the world are making considerable progress, and I think it's important that the UK keeps pace. So I've already touched on many of the kind of good things that are happening in the UK and what's being done well. But I think there is a risk to these significant and very welcome steps, and that the government's taken. I think the risk is that it could be undermined if the crypto sector is debanked and the crucial kind of on-ramp from fiat currency to crypto is choked off. And this is a similar trend to what we're seeing in the US, but for very different reasons. So in the US, it's coming as a result of pressure from the regulators, but in contrast in the UK, these kind of blanket bans or limits across the sector are being taken by banks despite the government's ambitions in the space. And in fact, the UK regulator is keen to see kind of a proportionate and risk-based approach to any de-risking. So what we're seeing in the UK is a number of the kind of UK banks introducing these blanket bans or limits on transfers to crypto. In the main, these measures seem not to differentiate between kind of licensed and regulated crypto exchanges and those that are not. And I think that that's a real shame, because it's clear that many UK customers want to participate in the crypto asset markets. I think around 10% of kind of UK adult population have currently hold or have held crypto assets. And if these transfer limits kind of create a ceiling on consumers' ability to participate and their individual choices, that will absolutely have an impact on UK market activity. And as a result of that, inevitably UK innovation investment will ultimately slow. And then UK customers will seek access to services from other jurisdictions and be exposed to intermediaries in kind of offshore without the same level of risk controls that we've kind of already talked about. So I think these limits do pose a real threat to the UK's future status as kind of like a hub of innovation and crypto asset activity. Many in the industry, including Coinbase, are kind of very supportive of efforts to kind of protect consumers participating in crypto asset markets. And we think that the best way to achieve that is through kind of well-considered regulation, which is precisely what the government is actually doing. So we think it's very premature for the banks to kind of be pulling up the drawbridge and restricting access to crypto assets at this juncture. And rather now we think it's appropriate time for the banks and the crypto industry and policymakers to kind of work together to reduce risk and really promote innovation in the UK.
Great, thanks. Dina, any more thoughts on the future of UK crypto?
Yeah, I mean, I echo what Katie's just said, and just to reiterate that I think the government's approach is right, but as we've said, the devil will be in the detail. There's a lot of nuances that haven't been worked out or have slightly missed the mark in terms of the risks that are being mitigated and how you mitigate them, and also how you retain the flexibility, as I said earlier, to move with the technologies that will keep on developing. So the potential is there, but there does need to be a very clear delineation of what the risks are, how they're being approached, and whether those are the right approaches. And as George said, I think that the industry's responses will be very important to this consultation in shaping how this actually pans out in the future legislation. And it does have the potential to really create a crypto hub here in the UK, but it also has a potential, as Katie said as well, to sort of drive more firms offshore. Competitiveness is really important, but I think there will also be quite a lot of consolidation in the market because certain firms will find it more difficult to comply with the rules, and where they have to change their business models, they may just find it easier to go offshore. So the principle is good, but there is a balance to be struck, and I'm not sure which way it will go, but I'm positive it will be a net positive.
And so the unintended consequence could be firms looking to move offshore, but generally a positive. We remain positive about the proposals. George, any final words there?
I think I mean, it wouldn't be a crypto webinar without a little bit of bashing of the FCA, right? And that needs to be undertaken because it's mandatory. But one of the questions I see we've got in the chat is all about how this works in practice, because we've got the consultation from HMT, which broadly I think is sensible. I know I've called out some issues with it speaking earlier on, but overall I think it broadly sets a good tone, and I think it's the right way to try and pitch this, and I think it makes sense to try and build all this into existing securities frameworks with appropriate changes. But the problem we see this is highlighted by one of the people in the questions, is that the HMT sets a broad overview, and then the FCA then comes in and sets detailed rules as to how to comply with those. And we saw this with the financial promotions requirements. HMT said, right, make crypto subject to FinProm. And the FCA said, okay, sure, here it is. And also we're going to add all this direct offer stuff in, restricted mass market investment, and lots of very restrictive rules that weren't prescribed by HMT. And I worry that this is going to be, another version of that. So we have a consultation that sets out a broad set of quite sensible rules, but then it's handed to the FCA, and the FCA creates very detailed requirements, as is it's within its mandate. But those detailed requirements ultimately are extremely difficult to deal with and go way beyond, what you would normally expect to see, when we're thinking about same risk, same regulatory outcome. And so I'm extremely nervous about that, and that plays itself out on a day-to-day basis at the moment with the registration stuff that I mentioned in my previous monologue, where essentially the FCA is applying an extremely high standard of requirements to firms that are seeking to get registered beyond anything that can be kind of predicted or managed in practice. And that's making life very, very difficult, which is at odds with what we've been told by the government, is that they want to be a crypto hub. Understandably, the rules need to be very strict, because there is risk within the industry and that needs to be dealt with. But there's strict rules, and then there's rules that are impossible to comply with in practice. And ultimately, at the moment, many engagements I'm having with the FCA are generally broadly net negative, simply because it's impossible to actually advise clients at the moment as to what the FCA wants and what it expects to get the best outcome for the client. It's just it's a lose-lose for everybody. So that's my ongoing concern, is that we're not going to maintain competitiveness in the sector until we have a regulator that's willing to work with the industry a little bit more than they are at the moment.
It's a really interesting thought. I mean, we've seen a lot over the past few months, perhaps past few years, of the government saying they need more call-in powers, they need more oversight of regulators. Do you think, erring more towards that sort of government oversight of regulators could help with that? So creating some sort of SLA for authorizations to have to meet certain targets in terms of authorization, providing certain information, providing certain guidance, providing certain clarity. Do you think that's sort of a model that we could move towards? Would that be a net win, or would that be too much bureaucracy for what we're looking at here?
It's so difficult to work out, isn't it? I don't think I have the answer to that, other than to say, I think there's not having an independent regulator in many ways makes a lot of sense, because you don't want the regulator to be swayed by government too much. But that's normally in relation to managing risk. And I think that at the moment there's quite a lot of managing of risk, which makes sense, and that is the regulator's job. There's also managing of public of the public perception of the regulator as well. The FCA does not want to be authorizing firms that then collapse with huge retail losses. Totally understandable, right? But then the understanding that risk and actually managing it in practice is two different things. At the moment, we're going the wrong way, and I think it feels to me like, regardless of what we say to the FCA, or what we say to HMT, or what we say to the government, the FCA just doesn't seem to be listening at all. I give the example of this webinar I did yesterday with the FCA, where this is public, in front of 300 asset management firms in the UK. They were very clear that their competitiveness obligation is a secondary obligation, and that was it was almost said as an incredibly defensive statement, almost as if now I'm used to hearing that kind of thing when I'm engaging with the FCA in relation to crypto, because they are quite defensive on crypto and they're quite nervous. But with the UK authorized asset management industry, it sounded like they were very suspicious of innovation. That was my personal sort of take from that statement that the FCA gave yesterday, and it disappointed me somewhat that even with something as sort of well regulated and well established as the UK asset management industry, that there's a suspicion on innovation, which came through from that response yesterday.
which again is interesting. It's at odds with the you know, they're a leading light in terms of promoting innovation, thinking differently about new business models and new risks. I guess there is a sort of element of risk aversion that is warranted, but the danger is you swing too far in one direction and become more restrictive, which could lead to all of the things that Dina and Katie spoke about in terms of offshoring of firms and all of that. I think we're on to question time, Sue.
We are indeed. Thank you, Jordan. And I know we've done a very good job throughout the session of actually answering some of the questions as they came through. But there are a couple of others that I just wanted to pull out here that have come through the chat as well. So one that's come through is asking the question, do you see any regulatory obligations for KYC or AML within a DeFi specific framework? I'm not sure who would like to take that.
I'll give it a go.
Well done, George.
I mean, the answer to that is I'm very sympathetic to the DeFi industry and the position with respect to AML, KYC, and sort of the difficulties that it would take to implement that. And it's sort of completely against the ethos of the industry. The one thing I'm really nervous about with DeFi is that I cannot currently see a world where a regulator would somehow regulate DeFi industry without imposing some form of ID and verification. Not because I think it's right, but because I think they're not in that mindset. And for me, you know, this is a fairly short answer, but that's my nervousness, is that I don't see how the two things can work together. ID and verification is a fundamental part of every single regulatory obligation that the FCA and HMT have in place at the moment. You know, anybody who's regulated by the FCA is subject to AML requirements, and so that's a core part of their ethos and their thinking. And one thing I just don't know at the moment is how they can reconcile that with then regulating DeFi without kind of placing those ID and V requirements on the industry. So I don't have an answer to it other than to say I'm nervous about it and I don't know quite which way they're going to go.
Yeah, I'd agree with that. Also, I'm nervous about it. And I would say that we're already starting to see signs of this in Europe debate around whether the Europeans will allow kind of anonymous self-hosted wallets. So by virtue of that, what they mean is KYCing self-hosted wallets. I think that's just the first sign of where policymakers may go in this space.
Fantastic. A slightly broader one that came through directly, and hopefully this is one that everybody can have an opinion on. We've obviously gone through what's in the consultation and some of the things that are in scope. Is there anything that any of the panelists think is out of scope at the moment that should potentially be considered, whether that's in the next phase or something that you think has been fundamentally missed from the consultation process? And again, I'll open that up to any of the panelists who want to step in.
I think perhaps one of the things that I sort of I'm a little bit mystified on, and perhaps time will tell on this one, but in terms of prudential requirements, we've seen the BCBS come out with their standards at the end of December, and this is probably thinking beyond the consultation, so apologies for that. But we haven't really heard the FCA, what the FCA approach is going to be, or the Bank of England's approach is going to be towards setting prudential standards. I think the EU have reacted pretty quickly. They came in January, adopted the BIS standard wholesale, but you know, whether it's for my lack of reading of the consultation, I can't really see where those prudential standards are biting or where prudential requirements are going to come in. And I think that's probably something that's being left to the FCA to decide in their sort of secondary rulemaking process. But at this stage, it's sort of an unclear one for me, and hopefully someone's going to come in and say it's all clearly in there, Jordan. Just read the consultation. But that's I guess a concern for me, something that's sort of been left out.
I'd say for me, one thing that's been left out, or is an open question, is the interaction between the stablecoin regime that's being proposed and the new consultation regime. As we know, if you're a crypto exchange, you'll list stablecoins and you'll list all sorts of other assets too. How those two things fit together I think it still needs to be ironed out. And I suspect it's just because they were moving quickly and the stablecoin stuff had to come first because they felt that was an immediate risk. I think in reality, it's probably not played out in that way. And so now we're kind of catching up slightly, but that's a key piece I think that needs to be worked out is we've got these phases. How do the phases actually fit together? Are we going to end up with something that's disjointed and difficult to comply with in practice?
Dina, I think you were going to jump in there as well.
Yeah, I was just going to agree, and I don't think there are any major categories that have been left out, but there are a lot of gaps and a lot of details to be filled in. Yes, exactly. One of those is regarding stablecoins, George, and for example, it says that there'll be a regime for custody of stablecoins, and then there'll be a separate custody regime for everything else, and then there'll be a further consultation on custody for securities or some other part of custody. So there's a real disjoint there. And again, on prudential requirements, there's a lot that's mentioned, but not clearly thought out yet. And hopefully some responses to the consultation will give more of that color. Yeah.
Katie, was there anything that you'd like to add? No. Fantastic. There was one more question that came through. Similar kind of vein, but we have been asked, there are many different sectors and business models that could fall within these regulations that wouldn't otherwise under TradFi. For example, as one example, should a game studio building on the blockchain be treated the same way as a crypto exchange? Do you feel that the consultation has considered this possibility?
No. We've had this problem in the UK for a little while now with the registration requirement, where the definition of crypto asset is extremely broad, and that has led to real difficulties when it comes to NFTs are the most obvious. It's been very unclear and still is unclear whether they're captured by the crypto asset definition in the UK, but the view generally is they probably are. But then more broadly, using crypto asset technologies to provide for kind of wider business benefits, like using the blockchain as part of business infrastructure, could still trigger registration requirements. And I think at the moment the consultation doesn't really deal with that, beyond potentially sort of some very lightweight references to infrastructure related exemptions, but there's virtually nothing in there on that point. So that's a key point I think to bring out in the consultation responses, that we can't stifle innovation in relation to blockchain by requiring everyone to register as a crypto asset exchange.
Yeah, and I would add to that, I think it does say something about not talking about DLT specifically and talking, DLT platforms, and that's outside of the scope of the consultation. But in instances like this, they are necessarily linked. So I agree, they do need to work that out and be very clear about what's included and what it isn't, and that you're not having these unintended consequences, as you said.
We have the issue in the UK at the moment with the tokenized securities. I know there are some clients around who do tokenized securities, and if you are trying to list tokenized securities on your securities exchange platform, then your clients need to be obviously issuing securities that are tokenized, and they need to be registered as a crypto asset firm, even though they're doing securities-based activity. It's this kind of stuff that's just not been thought about, and it massively slows down innovation as a result.
Thanks all. There were no more questions that came through, so just conscious of time, on behalf of CryptoUK, I would like to say a huge thank you to Jordan and the team at Chainalysis for coming up with the outline for this, and also Jordan for double hatting as a moderator and panelist and offering some really good insight and opinions. Also, thank you to Dina, George and Katie for taking the time to join this conversation today as well. Your contributions have been really, really valuable and very well appreciated. We'll be sharing the recording with all of the registered attendees afterwards. If there are any questions that you have following this session that you haven't had a chance to raise, please feel free to get in touch with us and we can obviously put those to the panelists. But I'm sure everybody on the call would agree the same as I will. It's been a really great conversation, really insightful, and thank you all for making the time today. It's been a great session.
Thank you.
Thank you so much.
Very much.